So imagine a mid-sized logistics company suffers a crippling $10 million ransomware attack. Total system shutdown.
Yeah, trucks can't move. The whole supply chain is just frozen.
Exactly. And a few weeks later, a giant household name insurance company pays out that massive claim. But here's the crazy part. The person who evaluated that company's tech security, priced the policy, and legally signed the contract to take on that risk, they didn't even work for the insurance company.
It is a reality that shocks a lot of people outside the industry. I mean, we are so conditioned to think of insurance as a straight line.
Like, you buy a policy from an agent, and the giant carrier holds your money in a vault until something goes wrong.
Right, but there is actually a massive engine operating right in the middle of that transaction.
And if you're an insurance professional, or maybe a CPCU student staring down a grueling exam, or honestly just someone who wants to understand how financial risk is actually managed in the modern world, you have to understand that engine. So welcome to this custom-tailored deep dive for the Insurance Study Companion.
We've got a stack of specialized study materials, industry breakdowns, and exam guides to go through today.
Yeah, and we're going to extract exactly what you need to know about a vital, heavily tested, and widely misunderstood powerhouse, the Managing General Agent, or MGA.
It's the perfect topic to pull apart because you really can't grasp how the modern commercial insurance market functions without understanding the MGA. They are essentially the invisible hand shaping how new, complex risks are handled globally.
Okay, let's unpack this. We need to start with a rock-solid foundation of what an MGA actually is. Because looking at the study guides, it makes it very clear that people constantly confuse them with traditional agents. So mechanically speaking, what is the difference?
Mechanically, a traditional insurance agent is basically a sales distribution channel. Their primary function is to find a client, assess their basic needs, and sell them a policy provided by a carrier.
They are the frontline retail face.
Exactly. An MGA, however, is a specialized intermediary, and they operate with something called delegated authority. The actual insurance company, the carrier holding the capital, legally hands over their own internal operational powers to this outside entity.
Delegated authority. So the carrier is essentially handing over their corporate ID badge. What exactly does that authority let the MGA do?
Well, it lets them act as an outsourced underwriting department. Because of this delegated authority, the MGA evaluates the complex risks of a client. They build the pricing models, they issue the actual policy documents.
Wow, they do all the heavy lifting.
Right. But the most critical piece of this is binding authority. That is the legal power to officially accept the risk on behalf of the giant carrier.
Wait, really? So when an MGA says, yes, we will cover this $10 million cyber risk, the carrier is immediately bound to that promise?
Immediately and legally bound to that promise, yeah. Even if the carrier's own internal executives haven't looked at the file.
That is wild. So what does this all mean? It sounds to me like the MGA is basically a property manager for a wealthy real estate investor.
Oh, that's a good analogy.
Right. The property manager evaluates the tenants, does the background checks, sets the monthly rent, and signs the lease on behalf of the owner. They run the entire day-to-day operation. But if the building burns to the ground, it's the wealthy owner who takes the massive financial hit, not the property manager.
That gets right to the core of the dynamic. What's fascinating here is that the MGA signs the lease, they make the critical daily decisions, but they are doing it with the carrier's capital on the line. They have the authority to act, but not the ultimate financial liability for the claims.
Which immediately makes me think of, well, a massive structural flaw here.
How so?
If I am an MGA and my revenue comes from the commissions I make on the premiums I bring in, why wouldn't I just approve every single applicant?
Ah, right.
I mean, I could write terrible high-risk policies, collect my massive commissions, and when the claims start rolling in, just shrug and point to the carrier who has to pay for it all. Why would a carrier ever hand over a blank checkbook to an outsider?
Yeah, this raises an important question about moral hazard, and it's exactly why the contractual relationship between a carrier and an MGA is incredibly strict. Carriers don't just hand over a blank check.
So there are limits.
Very strict limits.
Yeah.
They give the MGA what is called an underwriting box, basically a set of strict guidelines. The MGA only has binding authority within that box.
Okay, and if they write a policy outside of those guidelines?
Then the MGA can be held financially liable for breaching their contract. Furthermore, the carrier conducts regular, rigorous audits of the MGA's files.
So there's a tight leash.
Very tight.
Yeah.
And on top of that, MGA contracts usually include profit-sharing contingencies. If the MGA writes highly profitable business, meaning the premiums far outweigh the claims, the MGA gets a bonus piece of that profit. But if they write terrible business that bleeds the carrier dry, the MGA loses that revenue stream and likely loses their contract entirely. Their financial incentives are actually highly aligned with the carrier's profitability.
Okay, that makes a lot more sense. But it still begs the fundamental question of why. If a carrier has to go through the trouble of building strict guidelines, constantly auditing this third party and sharing their profits, why not just hire their own internal underwriters?
You'd think so, right?
Yeah, like if you're a multi-billion-dollar carrier, just keep it all in-house.
Well, it comes down to the brutal realities of speed to market and the cost of specialized expertise. Let's say a traditional insurance carrier, one that has spent 80 years writing standard property and auto insurance, decides they want to get into ocean marine insurance.
Or environmental liability.
Exactly. They can't just assign their auto underwriters to start evaluating commercial shipping fleets.
Right, because the risk factors are completely alien.
Mhm.
You need people who understand maritime law, global shipping routes, port logistics.
Precisely.
Yeah.
Building that specialized team internally takes years. You have to recruit high-level talent, build entirely new technological infrastructure, develop complex historical rating models from scratch. The R&D costs are astronomical.
So instead, they outsource it.
Right. That carrier can partner with the marine MGA. This MGA already employs the marine biologists, the maritime legal experts, the seasoned ocean freight underwriters. They already have the proprietary tech.
So the carrier brings the balance sheet, and the MGA brings the turnkey expertise.
Yes. It allows the carrier to deploy their capital into new, profitable markets almost overnight.
And looking at the study materials, this need for specialized speed is why MGAs absolutely dominate the excess and surplus market, or the E&S market.
If we connect this to the bigger picture, the E&S market is the perfect habitat for an MGA. In the standard admitted insurance market, everything is heavily regulated by state insurance departments.
Right.
If a carrier wants to change a rate or alter the wording of a policy, they have to file it with the state and wait for approval. It is a very slow, bureaucratic process.
Which doesn't work if you were trying to cover a brand new, highly volatile risk.
Exactly. The E&S market, on the other hand, operates outside of those strict rate and form filing requirements. It has freedom of rate and form.
Meaning they can just make it up as they go?
Basically, yeah. Underwriters can instantly customize a policy and charge whatever premium they deem mathematically necessary for strange or highly complex risks. Because MGAs are built to be agile, specialized, and highly technical, they thrive in the E&S space where they can invent new coverage solutions on the fly without waiting 6 months for a state regulator.
Here's where it gets really interesting, because I want to ground this in the real-world scenario. The sources highlight cyber insurance. Let's look at exactly how an MGA's proprietary expertise works in practice. So our traditional carrier wants to sell cyber coverage. They partner with a specialized cyber MGA. How does that MGA actually evaluate the risk differently than a standard carrier would?
Well, think about how standard insurance works. An auto insurer looks at decades of historical data actuarial tables to determine how likely a 25-year-old is to crash a specific type of sedan.
Makes sense.
But in cyber insurance, historical data is almost useless. The ransomware attack vector used 6 months ago is already obsolete. You can't price a cyber policy by looking backward.
Because the threat landscape is evolving weekly, so what does the MGA do?
Cyber MGAs employ proprietary forward-looking rate models. They don't just ask a business to fill out a questionnaire. They employ tech experts who actively scan the applicant's external network vulnerability.
Oh, now actively scanning them.
Oh, yeah. They analyze the specific tech stack the company uses, their multi-factor authentication protocols, their exposure to zero-day vulnerabilities. They take all this real-time tech intelligence, run it through their proprietary algorithms, and generate a highly precise bespoke premium for that specific business.
So they're doing incredibly heavy analytical lifting. They price the risk, they use their binding authority to sign the contract, and the business gets their cyber policy. But again, to hammer this point home for the exams, when that business gets hit by a $10 million ransomware attack the next month, the MGA's bank account is completely safe. The traditional insurance carrier pays out the $10 million.
Authority, but not liability. That is the mantra. The MGA acts as the gatekeeper, but the carrier is the vault.
Now, because this relationship is so nuanced, the sources make it clear that the MGA concept is an absolute minefield on the CPCU exams. If I'm a student trying to memorize all these moving parts, it feels like it would be incredibly easy to fall into a trap.
It happens all the time.
Like if I'm taking the 520 exam on insurance operations and I see how much power the MGA has, I might naturally assume they're legally classified just like an insurance company.
And that is trap number one. The test makers know the MGA acts like a carrier, so they will try to trick you into classifying them as one. But fundamentally, an MGA is an intermediary. They do not hold the ultimate financial risk on their own balance sheet, which means they do not have the reserving requirements or the capital regulatory burdens of an actual insurance carrier.
Okay, so they aren't the carrier. But then trap number 2 is assuming they're just a really fancy insurance agent. If I'm taking CPCU 530, which is business law, I might just group them in with standard sales agents.
And that will definitely cost you points. The law exam focuses heavily on agency law and the legal relationships between parties. A standard agent has the authority to solicit business, but an MGA has delegated binding authority.
Right.
Legally, under the concept of apparent authority, if an MGA binds a risk, even if they made a mistake doing it, the carrier is legally bound to honor that contract to the policyholder. The legal stakes of what an MGA does are exponentially higher than a standard retail agent.
That makes total sense.
Ah.
The legal mechanism is entirely different. Now, what about CPCU 540, finance and accounting? The study materials highlight that MGAs play a unique role here, too.
Yes, they do.
If I'm studying premium flows, I might assume the client pays the carrier directly, and the carrier later cuts a commission check to the MGA.
That's trap number 3, the financial flow trap. Because the MGA handles the operational backend, they are typically the ones collecting the premium directly from the policyholder or the retail broker.
Oh, I see.
Yeah, the MGA holds that premium in a fiduciary capacity. They then deduct their negotiated commission upfront and remit the net premium back to the carrier. So from an accounting perspective, the MGA is deeply embedded in the cash flow cycle, which creates a whole layer of fiduciary legal duties they must adhere to.
And finally, the text mentions CPCU 557, commercial property risk management. Why is the MGA heavily tested there?
Because commercial property risk, especially in coastal areas prone to windstorms or facilities with high environmental hazard, requires specialized underwriting. A standard carrier might have a blanket rule that says, we do not write property insurance within 5 miles of the coast.
Just a hard no.
Exactly. But an MGA specializing in coastal property will use advanced, highly localized meteorological models to underwrite building by building. They understand the nuances of construction materials and wind load engineering, allowing them to confidently write coverage in areas standard carriers flee from.
It really is a massive ecosystem.
Yeah.
And the sources throw a lot of other entities into the mix that we need to keep straight. We've talked about agents, carriers, and MGAs, but where do brokers fit into this dynamic?
This is where we have to map the specific allegiances. An insurance agent legally represents the insurance company. An insurance broker, however, legally represents the buyer. The broker is shopping the market on behalf of their client, trying to find the best coverage and price.
And what if that retail broker can't find coverage for their client in the standard market? Say the client is a highly volatile chemical manufacturer.
Then that retail broker will go to a wholesale broker. Wholesale brokers don't deal with the public. They only deal with other retail brokers. They have big connections in the E&S market.
Okay, so they are the middlemen for the middlemen.
Pretty much. And very frequently, that wholesale broker will take the chemical manufacturer's application directly to an MGA who specializes in environmental liability. So the chain goes client to retail broker to wholesale broker to the MGA, and the MGA legally binds it on behalf of the carrier.
Wow. There are so many layers of intermediation there. And just to clear up one final entity mentioned in the text, the TPA or third-party administrator.
Yeah.
An MGA does underwriting. What does the TPA do?
It's crucial not to confuse the two. While some MGAs might handle minor routine claims, their core existence is built around underwriting, assessing risk, and pricing it. A TPA is an entirely different entity.
Okay.
They are hired by a carrier or a self-insured company strictly to handle claims administration. They process the paperwork, investigate the losses, and manage the payouts. TPAs manage the damage after it happens. MGAs manage the risk before it happens.
Okay, to help keep all these moving parts locked into its proper place, there is a great heuristic used in the industry to keep this ecosystem straight. The study sources lay it out perfectly, and it's something you should constantly reference when evaluating a scenario. Agent sells, broker represents buyers, MGA underwrites by delegation, carrier assumes the risk and pays claims.
It is the single best way to cut through the noise of a complex exam question. Agent sells, broker represents buyers, MGA underwrites by delegation, carrier assumes the risk and pays claims. When you face a scenario with 5 different companies interacting, apply that rule to figure out who holds the legal power and who holds the financial bag.
It instantly clarifies the battlefield. So, to bring all of this together and summarize the mission of our deep dive today, a managing general agent is not just a high-volume sales office.
Definitely not.
They are a highly specialized technical intermediary operating as an outsourced underwriting arm for an insurance carrier. Armed with delegated and binding authority, they have the legal power to evaluate complex risks, utilize proprietary pricing models, and instantly bind policies. Which is exactly why they dominate fast-moving specialty and E&S markets like cyber and environmental insurance.
Spot on.
But, crucially, the ultimate financial risk always remains on the balance sheet of the carrier.
That captures the mechanical reality of the MGA perfectly. But, as we wrap up, thinking through how much technical power these entities hold leaves me with a broader question to pose to you, the listener.
I love a good theoretical question. Let's hear it.
We've established that MGAs are the ones hoarding all the cutting-edge expertise in rapidly evolving modern risks. They hold the cyber talent, the localized climate modelers, the proprietary algorithms. If this trend continues and standard carriers rely entirely on MGAs to navigate the future, will we eventually see a world where MGAs hold all the real influence in shaping global risk standards? Yeah, will the traditional multi-billion-dollar insurance carriers eventually become nothing more than massive passive bank accounts entirely dependent on the MGAs to tell them where to put their money?
Now that is a profound thought to chew on. When the people holding the steering wheel are the only ones who actually know how to navigate the road, what happens to the person who just owns the car? Thank you so much for joining us on this deep dive into the fascinating hidden engine of the managing general agent. Keep asking those big questions, keep looking for the hidden layers of the industry, and go ace those exams. We will catch you on the next one.